Welcome back, everyone. To this explainer, today we're going on a seriously high-stakes journey right into the heart of corporate risk. We are unpacking the capitalization policy and fixed asset onboarding to really master the expense versus asset trap. Now, I know that might sound a little technical, but trust me, if you want to be vigilant about protecting a company's bottom line, spotting the difference here is literally your ultimate superpower.
Section 1. The Profit-Wiping Mistake. Okay, let's dive into this. Just imagine coming into work, expecting a massive annual performance bonus, only to find out it's just completely gone. Poof, just a big zero on your screen. Well, that is exactly what happened to one company's monthly profit when a rogue department head bought a 5-core factory machine and actually recorded it as a daily business expense on day one. By trying to write off a massive 10-year asset instantly, profits vanished, bonuses evaporated, and shareholders totally panicked. And why did this happen? Because the manager completely bypassed the financial guardrails.
Which brings us to Section 2, the rules of capitalization.
So, in plain simple words, the capitalization policy is this strict financial rulebook. It's the ultimate decider on whether a purchase is just a quick expense that gets used up right away, or if it's a long-term fixed asset that's going to provide value to the company for years. And right alongside that rulebook is fixed asset onboarding. This is the super strict physical and digital process of giving that new long-term asset a unique barcode, putting it officially on the balance sheet, and then slowly deducting its cost over its useful life. That mathematical process, by the way, is what we call depreciation.
And this brilliantly illustrates the whole concept. Think about buying a coffee versus buying an actual espresso machine. If you buy a 200 rupee cup of coffee, you drink it, you get your caffeine rush, and boom, it's gone. That's just a daily expense, right? But if you buy a 50,000 rupee espresso machine for the office kitchen, that thing is gonna make you coffee for the next 5 years. You didn't just waste 50,000 rupees today. You acquired an asset. The capitalization policy simply tells the company exactly where to draw that line between a quick cup of coffee and the long-term machine.
Let's look at Section 3, XYZ Limited in action.
So, let's see this rulebook in action in a real workplace. Imagine an employee, let's call her Ria. She buys some printer paper for 1,000 rupees. The system instantly marks it as an expense, which reduces today's profit, just like that cup of coffee. But on that exact same day, she also buys a brand new delivery truck for 20 lakh rupees. Now, because of XYZ Limited's strict policy, the finance team intercepts this purchase immediately. There is absolutely no way they are expensing that massive 20 lakh hit today.
Instead, they execute the exact 4-step fixed asset onboarding process. Step 1, like we said, they intercept the purchase. Step 2, they generate a unique digital tag right in the system, something like truck-001. Step 3, they physically stick a barcode right there on the truck's dashboard and log it into the official fixed asset register. And finally, Step 4, they mathematically spread that massive 20 lakh hit out over the truck's entire 10-year lifespan. This one single process is what protects the current month's profit from just taking a completely unfair 20 lakh nosedive.
Moving to Section 4, Opex versus Capex.
So, the crucial point is that beginners constantly mix up what hits the profit statement versus the balance sheet. Let's clear that up once and for all with this confusion buster. Over on the left, we've got Opex, or operating expenses. These are your short-term consumables, things you use up quickly, like printer ink, electricity, or travel. They hit the profit and loss statement immediately. Now, on the right side, we have Capex, or capital expenditure. These are your long-term investments, like land, heavy machinery, or, delivery vehicles. These hit the balance sheet as an actual asset. Honestly, mastering this simple distinction is your absolute first line of defense against financial disaster.
Section 5, the ghost asset trap. But what happens if a company just ignores these onboarding steps and forgets to properly record their Capex? Well, you invite some incredibly severe audit risks. You see, auditors don't just sit around in a back room staring at spreadsheets all day. No, they walk the physical factory floor. They will literally print out the fixed asset register, walk right up to a manager and say, "Show me the physical 5-crore machine matching barcode MAC 992. They demand, without exception, that the paper ledger perfectly matches physical reality.
So, imagine this nightmare scenario. Say a manager bought 50 expensive laptops, which absolutely falls under Capex, but they just casually handed them out to friends without ever properly onboarding and tagging them. Well, they have just created a massive problem. When the auditor walks the floor and cannot find those laptops, they immediately spot what we call missing ghost assets. And guys, this doesn't just result in a polite warning. It triggers an instant corporate fraud investigation because the assets exist on paper, but they are literal ghosts in reality.
Bringing it all together, correct capitalization and fixed asset onboarding ensures that your paper ledger perfectly matches physical reality. It protects your profits from being unfairly wiped out, and it definitely stops ghost assets from haunting your balance sheet. But remember, an auditor's vigilance never sleeps. What happens when the vendors providing those assets start manipulating the invoices before they even reach your desk? Do you think you could spot the fake? Well, join me in our next explainer as we tackle invoice fraud head-on. Until then, stay vigilant and keep learning.